Welcome back to my channel. Today I'm walking you guys through the part 3 of the EAT and reversal strategy. So, on today's EAT and reversal strategy, so we want to deal with the candlestick formations, how we can combine candlestick with the strategy to give us high winning probability ratio. So, here now, before we move into the main strategy, you need to understand some key candlestick patterns which will enhance our effective use of this strategy. So let me quickly try to recap your memory back to most of these basic candlestick patterns. I know a lot of you understand the patterns, but I'm very sure some people they just only know the bearish and the bullish candles, but the formation of that candles, they didn't really understand it. So just like when we are in our school days, when we were taught about um, human body, part of the body, male body, female body, and some other part of the body. So also we have some similarities with candlestick patterns because you need to understand the movement of the candle before you can even go into dealing with how to trade with it. So let me quickly share some of these screenshots with you so that I just walk you through the basic candlestick so that you understand it very well before we dive into the strategy. So here now, let me quickly go to my gallery. Now, if you look at this place, we have two candles here. We have bearish and bullish candle. So this bearish and bullish candle, we need to understand the movement. Now, on the bullish part, if you look very well, you will see from above, you will see high, close, open, and low. Now, the open is where the bullish candle started the opening of the new candles. That is where it started opening immediately. Let's assume that we're using 1 minute time frame, which telling us that every one more minute another candles will be coming out. So immediately another candle closes, and one candle closes and another candle opens. It's going to start somewhere, it's going to end somewhere. So where it opens, that is where you see the open. That is immediately it surfaces, as in when it open a new candle. When it open, that is where you see the open. So at a point where the the particular candle where it open draws down back to the low and retrace back up, that is where it forms the shadow. We also call it wick. The tiny line is what we call shadow or wick. So when it comes down to the low level, that is the area where it touches, and it cannot go beyond that before it reverses up. So and immediately it reverses up, those areas, those regions will form a shadow. And now from that open going up, it will form a ray body. When you see that big color green, that is the real body of a candle. And if you look at the close, when it gets to that level, it moves with that green body to the level of I. But because of bearish pressure, the candle moved down to close. That close is where the candle closes before another candle opens. So as it moves to that high level, and because of the bearish pressure, it comes down to that close level. That level will form a shadow. The level will form a shadow, and where it stopped before another candle opens, that is where it will form the close. So that is to tell you that the bullish candle open below and close above, while bearish candle open above and close below. So now look at the bearish candle now, the red candle. On this red candle now, we have open and close. Open is where the candle open, and close is where it closes. Now, at the point of opening, it extends up to form a bullish bar. But because of the bearish pressure, it cannot move beyond that high level. The candle has to force down to the level of open and come down to form the ray body. And at the point of close, it extends, that ray body extends to the point of low region before it reverses back up because of the bullish pressure. So you need to understand these two candles very well before you will really understand how to use it to trade to trade a technical to trade a technical chart, or to understand the movement, the price action of any particular market. So that is that. Now that I believe you all understand the candle formation now, we are going to make use of 5 different patterns. So we're going to make use of we're going to make use of a shooting star. We're going to make use of shooting star, hanging man, hammer, inverted hammer, doji, bullish and bearish arami. Those are the 5 patterns we want to treat before moving down to the chart. Now let's go back there. Now let's start from shooting star. Now based on our last explanation of candle formation, if you look at this place, we have a very long wick or shadow. Looking at the red small ray body, the candle strongly moves, the bullish move strongly moves to the high level. But because of the bearish pressure, it moves down that the bullish level down to the close level of where it begins. Now, if you look at this place now, the candle started the candle opened from the low, and it's moved up to the high level, and because of that bearish pressure, it forces it down to the level of close. That is why you see the long shadow, and you see a very minute, a very small, a very small um, bullish ray body. If we measure this ray body and the long shadow in proportion, at least we are going to have almost like 6 or 7 times of shadow of the ray body inside the shadow. So this is what we call a classical shooting star, and it's usually happen at the uptrend when bullish candle rallies up at a point where is likely to reverse back down. That is where you see a shooting star. The same thing happens with the red shooting star, because this red shooting star, we have we have a small, it opens at the very tail end of that red ray body, and from there it move up to that high level. But because of the bullish pressure, bullish pressure force it down to the level of open and eventually close at the low. So the proportion of this real body on the shadow is almost times 6 or times 7 of the length of that particular shadow or wick. So this usually happen at what? At the uptrend, when the market is about to reverse. But when you spot a shooting star at the top end, does not mean that there is going to be 100% reversal. It's possible that the candle may continue the trend. That is why you need to wait for confirmation before you decide whether you are going to buy, you are going to sell. So that is for shooting star. Now, hanging man is an opposite of shooting star. Let me see if I can get hanging man here. So hanging man is just an opposite of shooting star, but it also happens at the uptrend when the market is about to reverse. But because before you can decide whether the market is to be reversed or not, one good thing that I usually use to decide that is that that particular hanging man or shooting star must jump up above the last candle. There must be a kind of gap above the last candle, and when the next candle want to open, it will gap down as well. So that one will give us a likely 90 to 95% assurance that at least the market will continue in that direction for a certain period. So that is for shooting star and hanging man. So please, you need to understand both candles. Both of them, they are different, but they perform the same function at the uptrend. Now, the next one I want us to check is inverted or hammer. Inverted or hammer. Now, if you spot any what is it called, shooting star at the downtrend, when price is coming down, as in the bearish movement is coming down, and you spot something like a shooting star at the downtrend, that one at the downtrend is called inverted hammer. It's not a shooting star. Shooting star happens at the uptrend, while inverter hammer happen at the downtrend. So when you have a real hammer, it also happen during the downtrend pressure. So both inverted hammer and real hammer, they perform the same function. It's just that there's going to be some gap before and after. Now, if you check this particular inverted hammer I'm showing you, you will discover that immediately after the consecutive four uh, bearish pressure, a candle form with a green ray body candle form that eventually turned to inverted hammer. This inverted hammer gap down a little bit below the low of the last bearish candle. And if you look at the next candle after the inverted hammer, it gap up above the close of the ray body. So it's one of those signals, or um, the signals or red flag that you need to take note to know that there is presence of inverted hammer or hammer that is valid. I think you are following me. So after this, we now have another pattern which we call bullish arami. We have bullish arami and we have bearish arami. Bullish arami happen during the downtrend of a bearish pressure. Just like when we have these four consecutive bearish candles coming down, and all of a sudden we now have a green candle in front of a red, in front of the last red candle. But one good criteria you need to understand about it is that red, that last red candle must engulf the green candle completely. I repeat, that red candle must engulf the green candle completely to have a valid bullish arami. Just like the way we are looking at it on the circle, on the highlighted two candles. Immediately after the red candles, the fourth candles, which is red, completely engulf both the high and low ray body of the green candle. So if you have this formation, this is telling you that the market is, or the formation is what? Bullish arami. So bearish arami is the opposite of bullish arami. Bearish arami happens during the uptrend when we have bullish rally, and all of a sudden you have what? A red candle which completely engulfed by the last green ray body. So once you have that formation, that means you have what? Bearish arami pattern. I think we understand both the bearish and bullish arami pattern. We understand inverted hammer and hammer. We understand hanging man and shooting star. Please, after this, after you finish watching this video, go back and read it again. Google it, check it, try to understand it very well. That is when you will be able to understand the strategy we want to introduce to you, we want to combine with all this candlestick pattern. So the last one, but not the least, is what? Our doji. Now this doji can happen at the uptrend. It can also happen at the downtrend. So wherever it happens, you must ensure that it gap down or it gap up, either of the two trends that you spot the doji. Let's assume that you spot the doji at the uptrend. The that doji must gap up above the last previous candle, and the next candle after the doji must be below the 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 what is it called, the lower of that, the low of that doji candle. So if you have the next candle above that doji, that means there is likely a continuation pattern that will likely occur. But if you have your doji above that form the last resistance, that is where you have a valid doji. Now, looking at this screenshot, you will see that we have doji star, long leg doji, dragonfly doji, and gravestone doji. So doji star is just like a cross. It has equal high and low. As in, sorry, it has both open and close. They are equal, and they have that open and close that are equal is at the middle of high and low. So once you have this, just know that you need to check for confirmation. So what are the characteristics? You have cross shape, same opening and closing price, small equal length upper and lower wick. So that is for doji star, and we have long leg doji. So long leg doji is very long compared to the first one. So they have the same features because they have both their open and close. They also they have the same open and close, but the length of high and low is more longer compared to the doji style we have explained earlier. Extended upper wick, extended lower wick, greater volatility. That means the more the high and low, the more you have the distance between high and low, the more you have the high probability that at that point there's going to be a reversal in the market. Now the next one is dragonfly doji. Appears at the bottom of a downtrend, shows the rejection of lower prices and bullish signals. Can you see now? So we have it as dragonfly doji. So shows the rejection of the lower price, bullish signal. Now, this happen where at the downtrend, where there's going to be a reversal from bearish to bullish trend or bullish pressure. So the next one is what? Gravestone doji. So the gravestone doji appears at the top of an uptrend, shows the rejection of the higher prices and bearish signal. So gravestone doji is the opposite of dragonfly doji. So this one happened, I mean the gravestone doji happened at the downtrend, while dragonfly doji happened at what? At the uptrend when price is about to reverse. So with this, I strongly believe you understand the concept before we finally move in to um, how we can combine the strategy with with what um, with our hit and reversal strategy. So let me just pause this. So I'll come back to explain how we can now combine it, because if I should continue with this, the length of the video will be very long and it will consume a lot of megabytes. Let me stop here and try to record it in another section so that you understand it perfectly well. Thank you.